Good morning, everyone. Thanks for joining us today. Welcome to presentation number 3 in our Assurity Life series with Morgan Hohbein, joining us from Lincoln, Nebraska. Before we jump in, if you have any questions, please feel free to type those into the questions box on the right-hand side of your screen. We will make sure they all get answered at the end of the presentation. Afterwards, you can always give us a call to get a copy of the presentation or to answer any other questions you might have. And we'll just go ahead and kick it off. Thanks again for joining us. I'll hand it off to Morgan.
Cool. All right. Thank you for having me again. We're on week number 3 of our life series. So today we're going to be talking about juvenile whole life. So we have a few different products. 42% of the time, though, exactly actually, our participating whole life is used for the juvenile space. So we're going to talk about that product a little more than any of the others. But we'll talk about its main uses, which are typically for gifting and college funding. So with that, just a little introduction here. If you've been on the last few, you probably know all of this already, or if you work with Assurity. But Assurity is a mutual organization. We are just down the road from Art Jetter in Lincoln, Nebraska. We are rated with an A- rating with AM Best. And we're considered a one-stop shop since we do have such a large portfolio, which includes both life and health products and also annuities, from simplified to full medical underwriting. So even on the life side, we do have our simplified products, which would really just include the term and then the non-med limits that are built into the whole life products, to full medical underwriting as well. Like Sean said, I'm Morgan Hohbein. I'm the Regional Sales Coordinator here at Assurity. You'll also see the name Paige Phelps thrown around a little bit, but we work as a team with the Art Jetter group. So feel free to reach out with any questions. And like Sean said, if you have any questions at any point, you can either save them till the end or just type them in that chat box, and I'll try to check it periodically. Otherwise, we'll open it up for questions at the end as well. So just a little bit about what our webinar is going to look like today. We'll keep it to 30 minutes or under, so kind of short and sweet here, since we're just going over one market. But we'll go over the whole life highlights, and that's going to include both our participating whole life and our newly revamped single premium whole life product as well. Then we'll go over the juvenile market as a whole, and just kind of what that looks like, what the uses are, and what the opportunities are there. Then we'll go over a case study just to kind of put it into perspective and just kind of show you what we get calls on in regards to the juvenile market and the whole life space. And then I'll show you an illustration which kind of correlates with that case study as well, so you can kind of see what that looks like. So our whole life guarantee. So just kind of some of the reasons why whole life is a good product to use over, say, a CD or an annuity or whatnot. Level premiums. So those level premiums, they are guaranteed. They're not going to go up as you get older. Lasting protection is going to last a lifetime, and those premiums are guaranteed. The cost is based on the child's age at the time of application, so it's going to stay those lower cost premiums all throughout their life, so that's really nice, and they're guaranteed to never increase. The cash value is very competitive, especially on our product. As premiums are paid, that policy cash value builds, and you can borrow it, take loans out as needed. So that's kind of where the college funding comes in too. So we'll go into that in a little more detail here in a bit. The coverage amount, the death benefit will never decrease. Even if you are going to take a loan or whatnot, that's going to be taken against the cash value. So that death benefit won't decrease, but it will increase over time. And then the tax-free death benefit as well. So great. Little part of that whole life there. So the participating whole life, just to give you some of the basics, some of the highlights there, just so you can nail these down. Issue ages, we start at 15 days, so you can get right in on those newborns. That's why it's great for newborn gifts. And we do go up to age 85, just to keep that in the back of your head. So face amounts, 15 days to 14 years, you're going to start at $15,000. So keep that in mind for the juvenile space. After that, it goes down to $10,000 and up. It's guaranteed renewable to age 121. So like I mentioned, it is lasting protection, lasts for a lifetime. And then the different dividend options there too. So there's quite a few. We actually have 5 different options. So there's the paid up additions, accumulated interest, reduced premiums, cash, reduced premiums with paid up additions. And then option 5 is just paid in cash, which is, besides the paid up additions, is probably a favorite. So different options there. And then the protected insurability. So that's a rider that you can add on for additional premium. And that will protect their insurability if they want to come back and raise the death benefit later on, or just need to change anything up within that policy as they grow. Because obviously things change, people get older, and all of that. Otherwise, if they don't touch it, everything will stay the same as it is guaranteed at that premium rate. So juvenile uses here for the participating whole life, we most often see it for college funding. And then the second would be gifting, and just future planning. So a lot of parents will already have a college fund created separately, so grandparents will gift on the side, just to cover their living expenses maybe while they're at college, or once they move out of the house, they just want to make sure that they're able to get on their own 2 feet, down payments for anything they need. So it could be a supplement to that college funding, or it can be used to pay back student loans. I'll show you kind of an example of that. But that's really the main 2 purposes that we see it used for in the juvenile space, which makes the most sense. I would say I definitely get the most calls on the college funding. Like I said at the beginning, 42% of those are going to be used for college funding. Single premium whole life isn't used a ton in the juvenile space, but when it is used in that juvenile space, I usually see it used for gifting. So they'll just write a $10,000 face amount, single premium when the grandchild is born. That's usually when I'll see it. Issue ages 15 days to 85 years, just like the participating whole life. You'll see the minimum face amounts there. This one's guaranteed renewable to age 121 as well. So just some more advantages of children's whole life insurance. So we covered this a little bit already, but again, it's guaranteed life coverage. It's renewable to age 121, and then guaranteed premium. So again, cost is based on the child's age, so it won't increase as they get older. It also won't increase if their health takes a turn for the worst for whatever reason at whatever age. So keep that in mind. Those premiums aren't going to go up as they get older. That cash value, you can borrow or take it out as needed. So kind of like I mentioned before, and I'll show you an example of this on an illustration, but some people will use it for college funding. They'll have the maybe their son or daughter take out student loans, and then just keep that cash in there until they turn 21 or 22 or 23, whenever they graduate college, and then pull that out in order to pay those student loans back, or they can pay it up front at age 18. Just kind of depends what their cash value is looking like there. The protected insurability, so I talked about that. That is a separate rider. So they can increase their coverage by 5 times before the age of 40. So again, that provides them the opportunity to keep increasing that death benefit, increasing that coverage as they get older or as they need it. But they also don't have to provide evidence of insurability, which is huge. And then affordable premium. So just to kind of put it into perspective here, $25,000 of coverage for that death benefit for a 10-year-old is as little as $22 a month. So if they're just wanting to get some sort of coverage, get some sort of cash value building there, they can spend as little as $22 a month for their 10-year-old. And obviously it's even cheaper the younger you start it. So keep that in mind, that it's a little more affordable than people assume. So now we're going to go into that case study for the whole life for children here. So this is a scenario that I get very, very often. If I ever get calls on juveniles, this is most likely what the scenario that I receive. So that's why I kind of wanted to touch base on this, and I'll show you illustrations on both. So I'll get a call from the agent saying that parents are able to spend X amount of dollars per month on each of their children. So in this case, they're calling me telling me they can spend $100 on both their son and daughter each month to fund their whole life insurance policy and kind of use it as college funding as well. So the boy's age 3, girl's age 5, and their goal here is for college funding, just having a little bit to help pay back loans after graduation. So again, their main concern here is college savings and funding, helping pay back any student loans that they have to take out for tuition, books, boarding, all of that. And they're just looking for good cash value growth, which is what you're going to get with that participating whole life. And then those dividends on the side are just going to be just a little additional bonus. So they decide to go with the Assurity participating whole life. They put $100 per month per child into a whole life policy, which when you're running the illustration, you can just put in the premium you want to pay instead of that face amount. So the total non-guaranteed death benefit at the end of that first year, just for $100 a month for the 3-year-old boy, is going to be $277,000. And for the 5-year-old girl, it's going to be over $300,000. So awesome death benefit, which is, not their main concern here. But once they turn 22, which is about typically graduation age, 22, 23, they'll both have at least $15,000 on the non-guaranteed side to pay back those loans. Then I'm going to show you an illustration and what that looks like on both the guaranteed and the non-guaranteed side. The guaranteed side, we're going to have an interest rate of 3%, so you're going to be guaranteed at least that 3%. We do come out with those interest rates each month, so if you do have an AssureLink account created because you're contracted with Assurity, you can use that agent ID to create an agent portal website, and you're able to access those. I also did send them to Sean last week when we were talking about both all of the permanent life products. So we do come out with that monthly, so you can keep an eye on that and what those interest rates are doing and dividends look like and all of that. But this is what it looks like for the 5-year-old girl, and this is just the first page, so we're able to see up to age 40. So like I said, I circled that total death benefit at the end of year 1 for just $100 a month, and we're going to get $308. And then looking at the cash value, it's going to start gaining some cash value after that first year, kind of slowly, but it really starts to build after age 11, after year 6 of that policy. And by the time she turns 22, she's going to have just a little over $15,000 in cash value that she could pull out or borrow from to pay back those student loans. If she wants to pay it up front, looks like at age 18, she has a little over $9,000. So just a kind of a little snippet there of what that illustration looks like. And you can see that cash value grow on that non-guaranteed side. Even on the guaranteed side, looks like we're going to have over $13,000 to use there. And that's with just $100 a month. So for the 3-year-old boy, it's going to look similar. The total death benefit is going to be $277,000 after that first year. And then that cash value gets up to $17,000, nearing the $18,000 mark after that at age 22, so about the time when he would graduate. But at age 18, he's going to have almost $12,000. So just a good little side amount for college funding. Maybe this is a supplement to another college savings plan that they already have set up, or maybe one that their grandparents have set up, or another family member. But this is going to help cover, depending on where you go, maybe a year of college, maybe a half a year of college, or maybe just the boarding and books part, the living expenses. So, and then they're going to have that death benefit solidified as well. So a lot of benefits that come with this over a CD or an annuity as well. So to kind of wrap this up, and told you it was going to be kind of a quick one since there isn't a whole ton to go along with this market. It's pretty cut and dry here. Just to kind of touch base though on a couple of the other optional riders that you can add. We talked about the protective insurability benefit rider, but that's really the only good one that's going to be for the juvenile market. There's also that value enhancement rider for the older ages, if we're just talking whole life in general. And this usually, a lot of these start at age 18, but they could do the accident-only disability rider, accidental death. If you're doing whole life for an adult, there is a children's term rider as well that you can add on, the disability waiver of premium. So just a couple other things just to add on. That critical illness rider you can add on as well once they turn age 18. So keep that in mind as well. So just 3 simple steps, just kind of going into the process part of it. Determine the need. So first you're going to want to find out what they're kind of looking for here and what their main purpose of gaining that whole life policy would be for. So again, for the juvenile market, a lot of the time it's going to be that college funding, or it's going to be a gift for a newborn, especially in the case of single premium whole life. That's typically, if someone's using the single premium whole life, it's going to be for a newborn, and it's just going to be a lump sum of cash that the grandparent wants to give as a gift. So again, determine that need. Then we're going to illustrate it, kind of show them the guaranteed side and the non-guaranteed side, and kind of explain the difference there. Again, the guaranteed is going to be at 3%. And then the application, we do have an e-app available for all of our products, so all of our life products, all of our permanent and term products, and then paper apps available as well. So those are all in AssureLink, which is our agent portal. So if you do need to get contracted, feel free to reach out to Art Jetter, and they can help you with that process. They can help you run any sort of illustrations as well. But that kind of wraps up our juvenile discussion for today, and I'm going to open it up to any questions that we have. So Sean, let me know if you get any on your end.
Yeah, we've already answered a couple on our end here, but there's some more rolling in. First off, with that protected insurability rider, what are the triggers? When can we access that and increase that face amount?
That is a good question, and that's one that I didn't come prepared for. So let me do a little more research on that and see when we could start increasing that as a juvenile. I'm not sure if they have to wait till they turn a certain age or whatnot. So Sean, I will send that information to you, and you can pass it on to everyone that was on the webinar.
Perfect. Yeah, as soon as you get that out, I'll email that out to everyone that attended. That's perfect.
Great.
And then next question, why would you consider this participating whole life over an IUL? What would the benefit be to that, in your opinion?
Well, we don't have an IUL here. We just have a current assumption universal life. So we typically always use this over even that. So I'm not very well versed in the IUL world, but so maybe Sean, you could even, since you kind of work with both, you could also chime in here. But I think just the cash value growth, I think, is larger. Again, I'm not sure exactly with the IUL. Sean, do you have anything to add to that, kind of in your experience?
Sure. Sure. I think there's a little more of a safety net with a participating whole life than there is an IUL. There's not quite as much risk you're looking at.
Right.
I actually have a couple good case studies that would probably be easier to look at than me trying to explain right here.
Yeah.
So I'll grab a couple of those and I'll actually send those.
Cool.
With that, I'm not actually seeing any other questions. If anybody else has any more questions, don't be shy. Just punch them into that questions box on the right-hand side of your screen there. We'll make sure they get answered. We've had some good ones so far.
Mhm. Yep, and I'll make
And while
sure
we're waiting for that, we'll hang out.
Yeah.
Yeah, we want to make sure everyone gets their questions answered. And while we're hanging out for a second, I just wanted to say the next webinar in the series is going to be the same time next Tuesday. We're going to go through the revamped single premium whole life product, which I know I'm very excited for. It looks really good. So make sure you register and save your spot for that.
Do that. Well, and I'll make sure you get all those details of a protected insurability rider to you after this.
Awesome. Still not seeing anything else roll in, so I think with that, I will say thank you, Morgan. Thanks again, everyone that joined us today, and hopefully I'll see all of you next week.
Cool. Awesome. Thank you. Everyone have a great day.
Thanks, guys.